Imagine investing your life savings in one company. A company you believe in. A sure thing. Then, overnight, it collapses. Your future, gone. What if there was a simple, powerful strategy to make sure that could never happen to you? In our first 2 episodes, we built the foundation of your financial house. We learned about the incredible engine of compound interest, the force that builds wealth. And we unmasked inflation, the silent thief that erodes it. But there's a missing piece to this puzzle. A question that stops millions of people from ever starting their investment journey. What if I lose it all? What if I pick the wrong stock, at the wrong time, and watch my hard-earned money vanish? This fear is real. It's powerful. And today, we're going to disarm it. Consider the story of 2 colleagues, Chloe and David. Both decide to start investing with the same amount of money, $10,000. Chloe is a researcher. She's cautious. She spends weeks learning about different types of companies in different industries. She decides to split her money up, putting some into well-known technology companies, some into healthcare firms, some into companies that sell everyday consumer products, and even some into international businesses. It feels slow, unfocused, even. David, on the other hand, thinks he's found a shortcut. A single, small biotech company is getting a lot of buzz online. They have a promising new drug in development. The hype is huge. If it succeeds, the stock could multiply in value. David sees Chloe's approach as timid. Why settle for average returns from a dozen companies when you could get spectacular returns from one? He goes all in. He puts his entire $10,000 into the single biotech stock. For a few months, he feels like a genius. The stock climbs 20%, then 30%. He's already made $3,000 on paper. Chloe's collection of investments has only grown by about 4%. But David has made a critical mistake. He has mistaken a gamble for a strategy. The biotech company announces that its new drug failed its final clinical trial. The news is catastrophic. The next morning, the stock price collapses, falling over 80%. David's $13,000 investment is now worth just over $2,000. In a single day, years of savings are wiped out. Chloe's portfolio, meanwhile, also felt the news. Her small allocation to tech and healthcare stocks dipped slightly. But her consumer goods companies and international stocks were completely unaffected. Her portfolio as a whole dropped by less than 1%. What was a financial wipeout for David was just a normal Tuesday for Chloe. She didn't have a crystal ball. She had something far more powerful. She had diversification. It's a word you've likely heard, but it is the single most important principle for managing investment risk. And it's beautifully captured in a simple phrase: don't put all of your eggs in one basket. If you are carrying one basket and you trip, you lose everything. Scrambled eggs. But if you spread your eggs across 5 or 6 baskets, tripping and dropping one is not a disaster. You still have plenty of eggs left. Diversification is your strategy for surviving the trip. Because in the world of investing, you are going to trip. Everyone does. So how do we apply this? Think of your investment portfolio not as a single lottery ticket, but as a well-balanced sports team. You don't build a championship team with only star quarterbacks. You get destroyed. You need offensive players, like growth stocks, that have the potential to score big points. But you also need defensive players, like more stable, dividend-paying companies, that protect your lead when the market gets rough. You need players from different backgrounds, who excel in different conditions. This is the core of diversification. There are 3 main ways to build your team. First, is diversification across asset classes. This means you don't just own stocks. You might also own bonds, which we'll cover in a future episode, or real estate. These different assets often behave differently. When stocks are down, bonds might be up, providing stability. Second, is diversification across sectors and industries. This is what Chloe did. Within the world of stocks, she didn't just buy tech companies. She also bought healthcare, financial, and industrial companies. When one sector, like tech, is having a bad year, another, like energy, might be having a great year. This balance helps smooth out the ride. And third, is geographic diversification. This means you don't just invest in companies in your own country. The US stock market is huge, but it's still only about half of the world's total market. By investing globally, You gain access to growth in Europe, Asia, and other emerging markets, protecting you if your home country's economy slows down. In finance, there's a famous saying, there's no such thing as a free lunch. It means that to get a higher reward, you must always take a higher risk. But diversification is the closest thing we have to a free lunch. It is the one strategy that has been proven to lower the risk of your portfolio, without necessarily lowering your long-term expected returns. It's a tool that helps you stay in the game. And staying in the game is how you win. David was forced to sell at a huge loss. Chloe was able to stay invested, allowing the power of compounding we discussed in our first episode to continue working its magic. This idea should be liberating. It frees you from the impossible task of trying to pick the next single big winner. Instead, your job is simply to build a wise, resilient, and balanced collection of many good companies. In a future episode, we will show you the simple and powerful tools, like ETFs and mutual funds, that allow you to buy hundreds, or even thousands, of these baskets with a single click. But for today, the lesson is clear. The goal of investing is not to avoid losses. That's impossible. The goal is to ensure that the losses are never catastrophic. Diversification is your seatbelt and your airbag. It's the structural engineering that keeps your financial house standing during an earthquake. It turns a terrifying tightrope walk into a stroll across a wide, sturdy bridge. Build your bridge, spread your risk, and invest with confidence.